Hi, my name is Megan Thompson, and today I'll be introducing the topic of Converging U.S. GAAP with IFRS and the discussion that it's a better option than converting directly to IFRS. So as we all know, the U.S. is currently subject to the U.S. GAAP, which is generally understood to be a rules-based accounting standard that is less subject to interpretation. In 2002, IASB was established to develop IFRS, which is the International Financial Reporting Standards, as a new global accounting standard. Since the creation of IFRS, approximately 120 nations require IFRS for domestic listed companies, with about 100 countries which have fully conformed to IFRS. It makes it a lot easier for companies and firms for comparisons because businesses can present their financial statements on the same basis as their foreign competitors. Now, the debate today is whether it's a better option to converge U.S. GAAP with IFRS or convert directly to IFRS. This topic is important to our profession of accounting because, as KPMG stated on their website, there are many reasons why the U.S. may want to consider adopting IFRS, either as a substitute or to complement the U.S. GAAP standards that are already applicable. First, IFRS is relevant to many U.S. companies, big, small, public, and non-public companies. It's very important for us to be able to use and access international markets that require financial statements prepared in accordance to IFRS. For example, some mid-sized firms which are unable to generate investor interest or capital in the U.S. may need to look overseas and get investments in that way. For larger firms, some that are seeking access to previously untapped markets may need to do the same. It is beneficial for U.S. companies that also have foreign investors, which attract foreign capital providers or that have foreign operations, to understand all aspects of those foreign companies. Also, if a company is acquired by a foreign company that prepares IFRS financial statements, it would be a little insensitive to not understand those IFRS financial statements. There are three main assumptions that I would like to talk about today that occur because of the change to IFRS. Those include the cost, the education, and the retraining. To begin with the cost, the tax consequence of using FIFO, because IFRS does not permit LIFO, which is last in, first out. Secondly, the continued cost of preparing financial statements for tax purposes. Then there is the retraining and re-educating currently practicing professionals that are going to cost money. And finally, the U.S. GAAP and IFRS differ on what should be included on financial statements. As we all know, that is the main issue that we're going to face, and also how the information is presented. So to accommodate that transition to a new accounting standard, existing computer systems that maintain the accounting records must be upgraded or new systems must be purchased. Companies are likely to maintain those new systems and legacy systems until the usefulness of the older ones expire. So in addition to the one-time cost of converting to IFRS, there's going to be ongoing costs similar to remaining on U.S. GAAP as we do now. So that IFRS education is also going to be implemented for our investors, our stakeholders, public accountants, and our management, etc. There was a study done in 2012, which was 10 years after the IFRS was initially created, that the SEC did, and found that U.S. investor knowledge of IFRS ranged considerably, with many unfamiliar with IFRS. With many companies using so many overseas investors, stakeholders, stockholders, everything like that, and not having enough information on IFRS is quite scary. And so being able to retrain those and following a more principle-based approach rather than a rules-based is important. So IFRS provides fewer detailed rules than the U.S. GAAP, according to AICPA's website, which we all know. U.S. GAAP is considered to be rules-based that relies on specific guidance and a list of detailed rules on how accounting principles should be applied to the economic events. According to an article I read discussing principle-based accounting standards, rule-based standards may not address all those unforeseen situations, whereas principle-based standards provide a framework for decision-making. So it's the spirit of how rules should be interpreted and followed. But when in doubt about how to apply the principles, IFRS always directs us back to the principles rather than the rules. So to begin our discussion today, we'll talk about converging U.S. GAAP with IFRS and how it is better than converting. So first, a vocab word, convergence. Convergence means that US FASB and IASB would continue working together to develop a high-quality, compatible accounting standards over time in the best interest of the capital markets. Our keywords here are over time. It's going to take a little bit because we have two big brothers that take a lot of work in order to form one decision. And so that jurisdiction would closely align some or all of its local GAAP with IFRS. So the convergence can be achieved by either incorporating specific standards from IFRS or modifying the local GAAP to more closely resemble IFRS. Now, in order to mitigate some of those transitional challenges that we're going to face, U.S. firms might be able to leverage the knowledge gained from overseas firms that have already adopted IFRS. Being able to leverage that knowledge from those firms could potentially result in lower cost of conversions for us as U.S. firms, and similarly, U.S. regulators may also be able to learn best practices from their overseas counterparts and help implement a smoother transition. For an example, the one I loved reading was in China. IFRS is neither required nor permitted, but the Chinese accounting standards has substantially converged with IFRS. So to a significant degree, IFRS was customized to a more easily understandable format for the Chinese markets. So they're able to combine in a way and be able to make it so it was easy to understand for both markets. I know that in the United States, it's believed that the US GAAP is the gold standard and that a certain level of quality will be lost with full acceptance of IFRS. Now, comparing it with the normal business operating cycle for individual firms and the economy, converting to a new standard arguably will require greater resources. But in the end, it will be so much more worth it since we deal with so many companies overseas. SEC states that its belief that a single set of high-quality, globally accepted accounting standards would benefit the U.S. investors and its continued encouragement for the convergence of U.S. GAAP and IFRS. Now, by doing so, the SEC chair believes that the convergence by FASB and IASB will enhance the quality and comparability of financial reporting. We all know how important that is. We need to be able to understand everybody's financial statements front to back and how they correspond to ours. We need to know how competitors are doing and how we are doing in comparison to our competitors. So with that greater need for transparency and accountability in our financial reporting, we need to be able to provide economy-wide benefits to our firms and investors through that accurate information. One way that these benefits are realized is through the efficient allocation of capital through our investors and our firms. Investors rely on our financial statements to make informed decisions on how to best invest their savings. So if we aren't able to incorporate that information to them in a useful and understanding way, then they won't be able to make their informed decisions on the other end. In agreement, the chief accountant of the SEC acknowledged that there is continued support in the U.S. for a single set of standards, but there is, one, little support for the SEC to provide an option allowing domestic companies to prepare their financial statements under IFRS, and two, there's no support to have the SEC mandate IFRS for all companies. So according to an article discussing the convergence and potential adoption of IFRS in the U.S. that I found on the FASB website, even under a single set of high-quality financial standards, financial reporting may vary among firms and industries. So if we converted completely to IFRS, there's still a chance that the reporting is going to vary. So this is why converging U.S. GAAP with IFRS is better than converting. Although it is important for a U.S. capital market participant to be financially bilingual. In this way, we have to be able to speak both IFRS and U.S. GAAP. For example, our stakeholders, they need to be able to require the comprehensive knowledge of the accounting differences. Those differences could include our tax requirements, merger and acquisition conventions, market regulations, and legal practices, but they also need to be able to understand the implementations of existing and evolving all of these. Since the companies are thousands of miles apart, being able to carefully access and assess this information is very important. Another transitional issue of adopting IFRS is that the financial statements at first might be misrepresented either intentionally or unintentionally. This is why it'd be better to converge. The pursuit of adoption of IFRS undoubtedly leads to changing concerns about the balancing of costs of doing so against the perceived benefits. However, convergence with IFRS would mean better quality information, which would offer better communication with our shareholders, our stakeholders, and ultimately lead to lower costs of capital. So being able to use that globalization of capital markets and growing cross-border economic transactions, we're able to see the information and how it's compared across the board to enhance investment decision-making for our investors. In addition, the learning curve of trying to understand two types of accounting standards for the firm's staff and auditors could lead to unintentional mistakes. So if we're still using GAAP and IFRS, then the financial statements errors could be significant. When that happens, then the business must reissue the financial statements. A significant financial misstatement could lead to a decline in a stock price, which then makes it difficult to raise capital. Now, if several companies have to restate their financial statements, then investors may lose confidence in the overall capital markets, or at least temporarily. So this is why we need to be able to converge and resolve those two standards and complete into one. Now, in turn, loss of confidence by the investment community could increase the cost of capital or limit the availability for credit of U.S. firms. The investment community might discount the firm's equity or demand higher premiums for the debt issued by our firms. In addition, a single set of global accounting standards that must address the needs of both the less sophisticated smaller economies and the more sophisticated larger economies may serve the best interests of U.S. investors and firms. Certain U.S. issuers without significant customers or operations outside the U.S. may resist IFRS because they don't have a market incentive to prepare IFRS financial statements, but being able to work with them and build them together is very beneficial. Since an outright move to international standards is off the table, FASB and IASB should continue to focus on improving the quality of their standards while, if possible, reducing those differences between IFRS and U.S. GAAP by converging the standards. Now, on the other hand, we'll talk about converting. Converting, little vocab, or adopting is what a lot of the articles and research papers that I read use. Converting means that the SEC sets a specific timetable when publicly listed companies would be required to use IFRS as issued by IASB. So that adoption is one approach that would accept IFRS without any modification set by IASB. So first, let's talk about the transition options from GAAP to IFRS because we'd be converting completely. The first way is for the SEC to choose a specific date that all public companies must begin reporting under IFRS. This approach might be the least confusing and most straightforward for firms and investors, and it makes the most sense, but it also presents a particular set of challenges. So not all firms are going to be able to adhere to a specific date. They all have different amounts of basic resources, human resources, technology, financial. Those are the three most important, and they are very necessary for the implementation, but they might not be all available at the same time. So another way to implement IFRS over several years based on firm revenue size or by industrial segment might allow our stakeholders sufficient time to adapt to those new standards without disruption in their firms or in the economy in general. Phasing in IFRS based on firm revenue size with larger firms adopting first could be justified on the grounds that firms with higher revenues are able to absorb those costs more readily than our smaller firms. So because of this, there are significantly more smaller firms than larger firms. As we know, the big four, there's like 10 more that are up there, and then everything is also pretty small. But it will allow more time for the supporting companies to scale up their resources to support that transition. So as those bigger firms are building the transition from GAAP to IFRS, the smaller ones are learning from those successes. They're learning from the failures of those larger firms that do have the higher costs, but that's because they can absorb those. But they're also, the smaller ones are finding ways to reduce their cost of conversion. So they don't need to be scared anymore of the conversion. They can smoothly transition along with the larger firms. So the potential for investor confusion exists. However, during the period of transition, as our firms within the same industry could be reporting under two different standards. So even though the smaller ones are weeding it out, holding on to their resources, the larger firms are working more with IFRS and we're working with GAAP still. And they might be in the same industry, but they're using completely different standards. So that's one some fall down. So another option would be to implement IFRS by specific industries over time. Those industry-specific implementations would be easier for investors and other stakeholders trying to evaluate the performance of a company among its peers. For example, my favorite example I read, it just made so much sense. Consider an individual who is specialized in auditing banks. Arguably, the knowledge of the banking industry is not so readily transferable to the natural resources industry. This approach might present challenges to smaller firms because they might not have the know-how or financial resources to convert simultaneously with their peers that have higher revenues within the same industry. So if we compare those two types of transitioning, either starting with the big, going on with the small, they might be in different standards at the same time, or we have the issue of all the same go together and they're going to be in the same, but then the smaller ones don't have those resources. They don't have those financial resources, the human resources, the technology available at this time. So companies with those subsidiaries in countries that require or permit IFRS may be able to use one accounting language company-wide. So according to PwC, when financial statements must be converted or reconciled to IFRS, or conversely from IFRS to GAAP, the complexity of the deal intensifies. For example, imagine a non-US company that has historically used local GAAP was planning an IPO, an initial public offering. They decided to use their local GAAP and reconcile it to be on time and cost efficient, like we all would suggest. But as a foreign private issuer, the company could have decided to change its primary GAAP from local to IFRS, which then could reduce the historical periods and align reporting requirements of the SEC. So this would have been eliminated the need for reconciling to GAAP in future filings. So kind of a couple issues there. But both buyers and sellers must conduct a rigorous due diligence to ensure that cross-border risks are identified and included in the purchase agreement. You need to be both on the same page. Now, in regards to adopting IFRS, there is IFRS 1, which is the first time adoption of IFRS, and it's a standard that helps companies transition to IFRS and making it more cost effective. It eases the burden and challenges of fully adopting IFRS, and it goes step by step. It makes it literally so easy. So first, they identify the financial statements, what every company is going to need. Then they prepare their opening balance sheet at the date of transition that we start at IFRS. Then they select the accounting policies that comply with IFRS and apply them retrospectively to all periods presented in the first financial statements. Next, they're going to consider their optional exemptions. They're going to apply the 7 mandatory exceptions from those retrospective applications, and then finally make disclosures to explain the transition. There are many updates and amendments to the first-time adoption. I just got really excited when I read about it because it just relieves the pressure during that full transition. It's such a huge transition from going to GAAP to IFRS, but it makes so much sense for all of these companies. Now that high-quality uniform global accounting standard, IFRS, or another internationally accepted standard might provide those company-wide benefits, and those benefits are going to easier access to global capital markets. Because of that uniform standard, it's going to make it easier for our investors to compare the performance under one standard rather than different standards. The easier access to global markets could potentially benefit our US firms in 3 different ways. We're going to improve capital allocations. We're also going to lower our cost of capital. Finally, we're going to have a greater market liquidity. We're going to be able to increase our cross-border investment interest, which could result in assets that could be easily purchased or sold without significant change in our asset price. So those are just a couple implementations for US investors and firms. Also, there's going to be a high quality uniform global accounting standard, which may provide, already said that. Sorry, next. Now, if those firms choose to issue financial statements under both standards during the period of transition, there's going to be costs to reconcile both sets of financial statements. We both know that, and provide some sufficient disclosures for investors to understand those differences in the net income, in the asset valuation, in all those differences, because firms are going to be able to decide if the benefits outweigh the costs of having to have both sets of standards audited or just having one set of financial statements audited, which we understand. It's going to be a terrible transition. It's going to cost a lot. It's going to be a lot of work. But in the long run, it's going to be so much more worth it for all of our overseas investors and companies. That globalization of capital markets and growing cross-border economic transactions is going to be vital. It's going to be able to compare everything across the board. In addition, it's going to curve the trend. it's going to curb the learning process of being able to understand the two types of accounting standards for the firm's auditors, which could lead to those unintentional mistakes. But like I said earlier, if those mistakes get too big and we start seeing a decline in our stock price and then our investors lose confidence, we aren't going to be able to succeed. We're not going to be able to grow our cross-border economic transactions. So being able to only have one standard and conforming to convert from US GAAP to IFRS is important. In conclusion, with the completed research, I believe that fully converting to IFRS is more beneficial for the United States. With that continued global adoption of IFRS, it means that the impact on multinational US businesses will only grow stronger, as additional countries permit or require IFRS for statutory reporting purposes and public filings. Right now, we have over $6 trillion of capital, US capital, invested in non-US securities. It is vital information that US investors keep looking overseas for those investment opportunities. Why wouldn't we? But we also need to be on the same page as them. The transition to IFRS could be long and complicated, but by learning from experiences and conversions in other continents such as Europe or Asia and see what their challenges are and constantly figuring out what we could do instead of, it will just make a difference between our IFRS and GAAP. Even with the increased costs of retraining individuals and companies, along with the burden of applying IFRS retrospectively, by using IFRS 1, which is that first-time adoption, it will provide accommodations needed to make that adoption cost-effective. There have been so many amendments to the IFRS 1 arising from new standards as they become effective. Right now, there are 19 different exemptions that we have in order to ease the burden of our retrospective application. So by using all this information and by being able to convert from GAAP to IFRS, it will be a lot more beneficial for our United States. Thank you.